Hey, Andrew here from The Investor's Way. Welcome to Woody's Weekly Wisdom, episode number 9. And this week, we're just going to linger a little bit more on interest rates. But as I promised last week, we're going to delve into the property market as well. So look at this. Mortgage holders, $141 billion refinancing avalanche as fixed rate home loans expire. Lots of really exciting words in there to really get the blood pumping. But the thing is with this one is that at the same time as we're seeing this headline, if you've turned on any of the morning news or evening news programs, then you're probably also hearing that they're all predicting that the property market has bottomed and that prices are starting to go up. So that probably, you're probably hearing that more than you're seeing this one, and you're probably thinking, "Wow, property market didn't stay down low for very long, and everything's nice and rosy when it comes to the property market." Well, let's take a little bit of a deeper look. Let me see. I'll try and get rid of these ads, but anyway, $141 billion refinancing. So basically, what's happened here in Australia is that we've got an enormous number of borrowers, as many as 900,000 borrowers, who took out loans when they were at very low, let's call it less than 3%, and a lot of them even at less than 2%. And they locked in their rates so that they took advantage of those. And right now they're probably thinking they did the right thing, and potentially they did. We don't necessarily need to get into that detail, but they've locked in these low interest rates. And what this headline's talking about with this $141 billion worth of fixed rate mortgages set to expire is telling us is that these people are about to come off these fixed rates and they're going to come straight on to the new variable rates. And basically, that means they're going from less than 3% to more than 6.5%. And that's a massive difference. And I think if we scroll down here, they're talking about here a borrower with a $500,000 loan is effectively going to be paying an extra, let's just get rid of that, an extra $1,000 a month on their mortgage, or 50%. Now that is, and that's for someone who was on 2.98, and we know there were some that are on even less than that. So that is a massive amount of money. Now, and that's going to put a lot of pressure on people to retain their homes. Now, the thing about this article that is, piqued my interest a little bit is it goes on to talk about, well, all you have to do is go and refinance. If you go and refinance, banks are throwing money at you to convince you to switch and giving you like $4,000 to go and switch your loans to a new bank, and you can lock in these reduced competitive interest rates that are available in the market. Well, there's one problem with that scenario, and for those people that have been paying the very low interest rate, the low fixed interest rate, they are at risk because rates have gone up by more than 3%, and 3% was the buffer that the banks used when they assessed those loans, which was regulated and required. So if they were on 2.98%, which was probably some of the higher fixed rates, and they were assessed at 5.98, if, as this article suggests, that they are switching to a 6.48% mortgage, or going up to a 6.48, that's a greater than 3% increase, so it's above the buffer they were assessed at. So the risk when it comes to what this article describes as simply going and refinancing is that you could be in what they're now terming, for obvious reasons, a mortgage prison, which is where if you were to apply at one of these other banks or a different bank to where you're at, you may fail the assessment for that loan that you already have. So even though you might be switching from a high rate to a lower rate, because even the lower rate will have a 3% buffer, you may, because of the increased payments, fail their assessments. And so it won't be as simple as just refinancing, because if you fail the assessment, you still can't refinance, even though you'd be refinancing to a lower rate. Now that is, like I said, being termed mortgage prison. And that is what is going to lead to, and why I'm moving into a discussion about the property market in this week's episode, is that if we have a bunch of people locked into mortgage prison at these higher rates and they can't afford those higher rates, then we all know what's going to happen. They'll be forced to sell. And that will lead to a bunch of properties being put on the market and people having to accept whatever they can get for these properties, which may or may not be more or less than what they paid for them. So when you start hearing right now, you're hearing all these discussions about the property market having bottomed out here in Australia. One of the factors that is driving that scenario, that is not talked about, is the fact that there's a lot less properties being sold. And when there's less being sold, so there's less supply, the demand chews them up very quickly, and that creates competition, which means prices stabilise in our case, or slightly increase, because people are forced to pay more than they really want to, because there's nothing else to buy. Now, if as a result of mortgage prison we end up with a bunch of people having to sell, and the supply balance changes, and we've now got a lot more properties on the market, and we've got some desperate sellers who will take almost anything, that is going to result in property prices dropping. So what I'm encouraging you to do with this week's episode of Weekly Wisdom is to be very, very careful about rushing into the investment property market on the assumption that we haven't reached the bottom. Now, I am a proponent for always investing and not trying to pick the bottom. Totally understand that that's my mantra. But let's not be fooled that we've reached the bottom yet. If you've got time on your side, then you've got you don't have to rush, and there is certainly going to be some bargains around when these fixed rate loan borrowers come out of their fixed rate environment and find themselves caught in this prison where they can't refinance because they're going to fail the assessment process, even though it would be at a lower rate than they're currently paying. And that means they're then stuck with this higher rate. They're forced to pay more than $1,000 a month in mortgage repayments that they may not be able to. And that is going to lead to more sales, more supply, and a softening in the property prices. And that is something that we don't see in this article. It does talk about mortgage prison, but it doesn't talk about the supply and demand equation when it comes to what could happen to property prices. But it certainly does highlight the risks in the next 6 to 12 months in the Australian property market because of these fixed rate borrowers coming off, and with rates having increased by more than 3% in that time, we're going to have a lot of people who are unable to refinance and therefore at risk of having to sell their property because they can't fund those increased mortgage repayments. So it's a real tricky scenario, and one that is not playing out in a big way in the media. But this, let me just move me out of the way. But this headline: mortgage holders 148 million, and it's very tough with that in the way. But yeah, 141 billion dollars worth of refinancing is an avalanche of fixed rate borrowers that are going to be having to make decisions about whether or not they can refinance, and if they can't, whether or not they can meet the repayments. And let's not, I guess, ignore the fact that even for some of those people who are going to refinance, the impact is still going to be huge, and it still could be problematic for them to meet their repayments. So it's a real difficult scenario, and one that I'm looking to investigate over the next 12 months to just see how it plays out, because I still believe there's going to be great opportunities in the property market here in Australia as these things play out. And right now, any talk that we've reached the bottom and that we're going to start to see a return to rapidly increasing property prices is folly. We've still got to get through this year, and with all these, as I said, all these fixed rate borrowers coming off, and you've also got a whole bunch of other people who are above the 3% margin in their borrowings, and they may also be under stress over the next 12 months. So really a lot of factors still to play out before we can confidently say we've reached the bottom of this cycle, and it's way too soon to say that we have, and I caution you in getting caught up in those headlines, and this is a really good example of that one, and this article really just telling half the story, which is not uncommon, and it's not a slight against the journalist, but this one only tells half the story, and that is that we've got all these people that could end up in mortgage prison, and that could have a very significant impact on the property market and the supply and demand balance. So right now, I guess there's a shortage of people selling, so therefore supply is tight, which means if you're buying, you've got to pay a little bit more, and that therefore is keeping prices relatively stable and in some cases rising. But as more and more properties come onto the market, we will see that soften a little bit, and that's when I think we'll see those statistics turn around a little bit more for a little bit longer. It's just a slight, I think it's almost like the summer impact, and once that summer impact here in Australia disappears, we go into the winter months where people are less likely to be selling. We're going to see a softening in those prices. So hopefully that was helpful. $141 billion avalanche of fixed rate loans being refinanced. And what does that mean? Mortgage prison, softening in the property prices over the next 12 months is a real possibility. So hopefully that helps. Let me know in the comments, and I'll see you again next week for another episode. We go into the double digits of episodes of Woody's Weekly Wisdom. Enjoy your week. We'll see you again next week.